Welcome back to Switzer on Australia's Business Channel. The recent rally has buoyed investor confidence, but Roger Montgomery warns there are 4 reasons why we should be nervous right now. Roger is Chief Investment Officer at Montgomery Investment Management, and he joins me in the studio. Roger, how are you?
I'm very, very relaxed.
Now, I want to talk about Macmillan Shakespeare before we finish.
Sure.
Let's get the main job today. 4 reasons to be nervous.
Okay, so reason number 1, very simply, is that we're not seeing a lot of value amongst the quality issues that we typically go fishing for. In the last 3 years in a row, when that's happened, when we've had very few new companies we don't already own, that are high quality, A1, A2, B1, B2.
Share price too high compared to the value that
correct.
Right.
So when we can't find many that meet our criteria, in the last 3 years that has precipitated a decline in the market. Now, I'm not saying that it will decline, because I don't know, quite frankly. I can't predict these things. And our track record is mixed at best when we talk about forecasting. But that's an observation.
Okay,
Not a lot of value, number 1. Number 2, China. Here's the interesting thing. In second quarter, Chinese fixed asset investment as a percentage of GDP went from 80% to 80%. It doubled from the previous quarter. Now, 2 years ago it was 60% when the rate was much higher. The rate of growth was much higher. The rate of growth was 11% or 12%. It's now 7.5%. It was 60% fixed asset investment, which is funded by local government debt. So it was 60% of 12, it's now 80% of 7.5. The rest of the economy outside of government spending has fallen off a cliff. Now they're trying to transition.
Our exports are more linked to the fixed asset investment, aren't they?
Yes, but it's a higher percentage of it. There's no growth, right? And the problem that you've got, is they're using it to buy assets or build assets that are generating no return or a negative return. So that's simply not sustainable. And what we're going to see, I think, is a further slowdown and a deeper recession in our mining and mining services.
So when you heard China say we're not going to go below 7%,
no, they didn't say that. The guy didn't say that. The Premier. This is a little bit like the Premier of New South Wales saying Australian economic growth will not go below X. You know, it was just his opinion about what he thought was acceptable. He's not saying that there's just one Premier.
I thought opinions in China were actually determinable. You actually could work out what the opinion would be.
But people have got to understand. People hear one Premier say something and they think, oh, that's it. It's the same as the Premier of Victoria. I do think the Premier of China
is just a little bit more significant than
There's a lot of premiers. There's a lot of premiers, Peter. Okay, so that's going to lead to, I think, further difficulties for Australian resources. Now, outside of... That's two. Outside of resources in Australia, the Australian economy is not going well. We just saw Seek's online job advertisements and we saw them declining significantly, and in WA, down 40%. 40% for the year, okay, compared to June last year.
Sounds huge.
That's a big drop in online ads. So these people that are coming off the job in mining and mining services, looking for work elsewhere, there isn't any. And so what we're going to see is we're going to see rising unemployment in Australia, and I think that's going to lead other people who don't necessarily have a job in mining or mining services to pull their head in and spend less.
Sounds like a very strong argument for a rate cut next Tuesday, but go on.
That's your job, not my job. And then number 4, the United States, the earnings growth. So stocks have gone very, very strongly because of the earnings growth profile in the United States. 107 companies have now reported in the United States. Out of those 107, if you take out financial companies, banks and the like, earnings growth is down 4%. On the quarter, that's a lot. Revenue growth, 0. So put those 4 things together, we think, 1, US stock prices in aggregate are unjustifiably high. We think Australian share prices are unjustifiably high based on the economic growth prospects of the country. We think that China is going to slow down dramatically, and we think that there's no value in the market.
The one thing I've got to say that we've talked for a long time, once upon a time, you never used to pin the selection of companies on macro issues. You often used to say, who cares? You used to say, who cares? I look at the companies, and I would say to you,
We
well,
do.
but if the macroeconomy is crap, that company's going to suffer.
But
You say, no,
in your introduction, we haven't changed the way we invest.
Yeah.
But the introduction, what we're talking about is reasons why investors should be cautious. So we're cautious. We can't find any value. We're 55%
I like that
cash.
indicator. That's one that really
We're
interests me.
55% cash in the Montgomery private fund, and we're scratching our heads saying, well, should we be buying anything? We can't find anything, and there's all these things to worry about.
There are some technical issues, I think, make me think that you could be right. But I guess for people listening now, is that, are you saying then that you want to be out of the market for a long time, or you want to be out until the correction comes?
Well, here's the interesting thing. This will lead us into the next part of the story.
Yeah.
I was asked yesterday by a prospective investor. They said, well, should I invest with you now or should I wait? And the answer was, well, I don't know, because your question is about timing, and I don't know whether now's a good time or not.
I just talked about it in my comment.
So yesterday we couldn't find any value, and yet today, this morning on the open, Macmillan Shakespeare opens at $7. And we bought a whole lot of stock at $7. It closed at $9. We made a couple of $1 million today, but we couldn't have anticipated that yesterday.
Yeah, but it's still guesswork, isn't it, for you? Because you don't know what's going to happen to this industry. But
so what we can do is
we can say it's not a gamble. But you're investing.
We can say there's a 60% chance of X happening, and if X happens, the share price is worth this.
Yeah.
There's a 40% chance of this happening, and if that happens, the share price is worth this. Add the two probability-weighted prices together, we get a probability-weighted intrinsic value, and on that basis, which was about $14 for the shares, they were trading at $7. They were nearly 50% discount to what we thought they were worth.
And do you sometimes have this sort of innate belief that there's always a market overreaction, and that does create an opportunity?
I don't know when it's going to happen, but it's guaranteed to happen.
Yeah.
There will be overreactions. That's the one thing we can predict with some confidence.
Yeah.
There will be overreactions, and it's our job to take advantage of those.
Well, basically, the theme I've been adopting with our viewers is, if you buy quality companies, when there's an overreaction, the market's sold off. Like, for example, BHP, which you thought would go into the 20s, and it still could if your analysis is right.
Correct.
I think you're wrong, but doesn't mean
That's okay.
Doesn't mean
That's
I'm
what
right
makes
either.
a market.
That's right. Precisely.
When I'm selling shares, someone's buying them.
Exactly
when I'm buying
right.
shares, someone's selling them. We disagree.
That's right.
Every day.
But certainly, I do like as a strategy buying quality companies. You like to add other things on that to test out the quality of the company.
Correct.
I agree with that. All right, so that's the issue. That's
So Macmillan Shakespeare is an interesting one.
Is it still a buy at $9? Because some people are wondering that. Roger, is it still a buy at $9?
Well, we think it's worth about 14, based on the probabilities of one, Labor not winning, or two, if they do win, the probability of them getting the legislation through. Okay, so we looked at all the probabilities through scenario analysis, and we actually published our scenario analysis this morning for Macmillan Shakespeare on my blog. So we put it up there so people can go to the blog and they can see our scenario analysis and decide for themselves what they think the probabilities should be. But based on our probability assessment, we thought the valuation was about $14. So at $7 it's cheap. At $9 it's still cheap. But I don't know what's going to happen to the share price in the interim.
That'll be.
I said in the investment committee meeting today, I said the Macmillan Shakespeare share price will be our election worm. So we won't be watching the worm on TV. We'll be watching the share price.
That's right. That's right. All right, we're out of time. Roger, thanks for joining us.
It's a pleasure, Peter.
Always
Thank
great
you.
to talk to you.